In this video, I'll explore some of the crucial questions for buy-to-let investors to ask when looking for a mortgage. As a mortgage advisor, every day I'm asked the same questions. I will be covering 40 odd questions over the course of a few videos, so why not subscribe so you don't miss out. So let's crack on. The first one. Do you have to own your own home to get a buy-to-let mortgage? You don't necessarily need to own your own home to get a buy-to-let mortgage. Lenders primarily assess your ability to manage the investment property. While owning your home can be an advantage, it's not a strict requirement. How much do you need to earn to qualify for a buy-to-let mortgage? To qualify for a buy-to-let mortgage, you typically need to earn enough to cover the mortgage payments and other expenses. Lenders often look for an annual income of around £25,000 to £30,000. However, there are lenders that have no minimum income and they consider factors like rental income, property value and your credit history. It's advisable to speak to a mortgage advisor such as myself to find a lender and a deal that suits your specific circumstances. Is it better to get a buy-to-let mortgage in your personal name or in a limited company? Whether it's better to get a buy-to-let mortgage in your personal name or a limited company depends on your individual financial and tax circumstances. Recently, some landlords have chosen to use limited companies due to tax advantages. It's important to seek professional advice from a tax advisor to determine the most suitable structure for your specific situation. So how much deposit do you need for a buy-to-let mortgage? The deposit required for a buy-to-let mortgage is typically 25% of the property's purchase price, but this does depend on the market and your specific circumstances, the rental income it's expected to generate, and the main one being whether you're a basic rate, higher rate taxpayer or buying for a limited company. So is there a balance between the amount of deposit and the amount borrowed from the lender? There's no exact science, just what you want to hear. A higher deposit can lower the borrowing costs and potentially secure better interest rates. A lower loan to value provides a larger equity buffer, which can mitigate risks in case of property values decline or rental income drops. Balancing a reasonable loan to value with the property's rental income is essential to ensure that the investment is financially viable. Ultimately, the optimum loan to value depends on your financial circumstances and investment objectives. It's advisable to consult a mortgage advisor like myself to find out the right ratio that suits your specific buy-to-let investment goals. This next question is a big one. Some lenders are offering low interest rates with high fees and others are offering high rates with low fees. Why do they do this and what's the best option? So this is an interesting one. The way that lenders have to calculate borrowing under the Prudential Regulation Authority rules can be quite complicated. In summary, in order for lenders to be able to lend more to you, they need to create products with low ICRs, which stands for interest cover ratio. Depending on what the market is doing rate-wise, depends on the cost of borrowing for them to lend to you. In order for them to lend more on a low ICR, they have to charge high product fees to cover their costs of borrowing before lending to you. It's a common misconception that a bank only lends on their own money. Consider how the fee structure affects your immediate cash flow. High fees might be a barrier for some borrowers, but in most cases you can add these to the mortgage. Calculate the total cost of mortgage over its duration, including fees and interest. This can help you determine which option is the most cost effective. Or just appoint me as your mortgage advisor, and there's more information in the description and comments. I'll see you soon.